Most budget roundups tell you what's changed. Almost none of them tell you what to do next. And this one's going to do both. I'll show you how the 25 and 24 budgets fit together and why your tax bill is going to steadily rise right through to 2031 and what small business owners should do now, and especially over the next 5 years. I always stay politically neutral. My only aim is to help you keep more of what you earn. Being a small business owner is already pretty hard. So come on, let's see if I can help you and let's get into it. I'm linking the 24 and 25 budgets together for one simple reason. For small business owners, they behave like one long rolling tax plan. 2024 saw us with employers' national insurance rising to 15% from April of 25. Employers' national insurance threshold dropped down to £5,000. Large increases in national living wage. We had higher capital gains tax, the rolling back of business asset disposal relief, and increases to stamp duty land tax. There were some early warning signs that came in 2024 about pensions and how they would fall into IHT and into estates. Now 2025 has brought another freeze to income tax and national insurance thresholds all the way until April of 2031. We've got dividend taxes rising from April of 26, savings and rental income tax rises from April of 27. Salary sacrifice national insurance savings are going to be capped from April of 2029. And we've got some changes coming to capital allowances very soon in January of 26. We've got an EV mileage tax from 2028, a reform on self-assessment payments from April 29, that was in the fine print. There were more than 80 measures in total within that budget, but I'm only pulling out the ones that actually affect small business owners. But my point to this is when you look at 24 and 25 together, the numbers are pretty clear. These two budgets raise around 26 billion a year by 29-30 tax year. It's a long list of small changes that are actually come across two budgets, and they're going to land across the next 6 years as well. This is why you need to plan. It's not just an exercise of raising awareness today. I want you to actively plan and think about what's going to happen. So if you're employing people, you need to know what's going to happen next. In 2024, we had changes to employers' national insurance. We went from 13.8% to 15%. We saw that drop in the employer's national insurance threshold from 9,100 to 5,000. Employment allowance went from 5,000 to 10,500. So at least we had some good news. But fundamentally, if you employ people, your wage bill is likely rising on two counts, either through employers' national insurance or through minimum wage increases. Even in my accountancy firm, only with 8 members of staff, the effect of employers' national insurance meant that we were paying a few £1,000s more every single year. From April of 2026, the minimum wage rate is going up for the over 21s, and that's going to 12.71%. That's a 4.1% increase. But the real story is actually in the trend. In April 2021, the rate was actually only £8.91 per hour. By April of 2026, it's going to be £12.71 an hour. It's an increase of roughly 43%. Plus, when it was 2021, the rate applied to 23-year-olds, and now it's 21-year-olds. Plus, apprenticeship hourly rates have risen much more steeply. No small business can absorb that without hurting margins. I saw a cleaner recently raise their prices for the first time in 3 years. With wage increases like this, I genuinely don't know how they managed it until now. So I want to give you some strategies of how you can manage this as employers. I want you to reprice. Don't absorb. It's a massive mistake. And I've seen clients this year not really understand the effect of employers' national insurance, and they've just been trying to absorb these costs, and it's a huge mistake. You should be modelling your 25-26 wage bill. And if you haven't done it already, then you need to be doing it now. You've got to factor in these new national insurance rates. I know they've been in effect since April, but go and have another look at them. These new thresholds as well for national insurance, it's really important that you go and revisit those. Factor in what's coming in April of 26 with the wage increases. Absorbing these changes, it's going to compress margin faster than anything else fundamentally. Second thing I want you to do is use your employment allowance fully. Thousands of small firms still don't actually claim it correctly. HMRC themselves and the Federation of Small Business actually highlighted this. There's some common mistakes: assuming one director companies can't claim, even though they're employing some people, forgetting to reactivate it in the next year payroll, misunderstanding the 100K employer national insurance rule. So if your employer NI bill is under 100,000, then you're eligible. And because the national insurance threshold's been dropping to £5,000, more small firms are actually producing employers' national insurance for the first time. So that means you should be absolutely aware of if you can claim that or not. The third thing is actually a little quick tip about employment allowance. If you're a sole director on a payroll with no staff, you can't claim the employment allowance. But if you take on even one employee, even for part of the year, and then they leave, you still keep the full allowance for that tax year. One of our clients had their brother do some work for the business in April. He left a few weeks later when the work was done, but because the company had more than one employee at that point of the claim, then they got to keep the 10,500 employment allowance for the rest of the year. Isn't that cool? It's one of those rare moments where the rules actually work in your favor, but it's worth checking your own setup because many small companies, they do miss out. So the fourth thing is I want you to review your director salary before April of 2026. There is a dividend tax rise coming in April of 2026, and I'm going to come back to that in a second. You've got these frozen thresholds, and it could be pushing more of your income into 40%, especially someone like myself where I've got quite diversified and mixed income from different sources. That means that classic director salary and dividend split may no longer actually give you the best outcome. So if you've got a small team and you've got some remaining employment allowance left, actually a slightly higher salary may start to make sense again. But here's a trap that I'm seeing all of the time. People say, Justin, if I take a bigger salary, then my company's going to pay less corporation tax. So surely I'll pay less tax overall. It does help the company because salary is an expense and it reduces profits. That matters if you are in the 26.5% marginal corporation tax band. And I've had clients say to me, look, I'm a 20% taxpayer. My dividends are taxed at 8.75. My company's paying 26.5% corporation tax. That's 28.75% in total. So if I switch to salary, the company says the 26.5% and I just pay the tax now instead of through self-assessment. That must be better off, right? It looks similar on paper until you actually run the numbers because your personal take-home almost always goes down. And here's why. It's because dividends were taxed at 8.75%. Salaries taxed with PAYE and national insurance, which is actually closer to 28%. And then you have to watch that employer's national insurance threshold as well at 15%. And from April of 2026, that dividend tax is going to rise to 10.75% anyway. So yes, the company saves tax, but the saving doesn't necessarily land in your own personal bank account. Most directors can actually end up worse off personally. And this is why you can't really effectively compare company tax and personal tax directly. You have to model your whole remuneration plan properly. This is where some expert advice is absolutely needed. Just to give you an idea, is myself, I take a hybrid approach. I take a higher salary combined with some dividends, but that's not going to be right for everyone. So go and speak to your accountant. If you want help understanding the 26.5% corporation tax band and how to avoid it, I'm going to put a link up now and there'll be a link to that video I recorded a little while ago all about that one as well. Salary sacrifice is next up. And in 2029, there's going to be a cap. And this is one of the most, I suppose, quietest but most important changes in the budget. From the 6th of April 2029, the national insurance saving on pension salary sacrifice is going to be capped. Only the first 2,000 per year of sacrifice avoids national insurance. Everything above that, you're going to pay national insurance on. You still get income tax reliefs, but the national insurance savings disappear. Salary sacrifice has been one of the most powerful planning tools for small business owners, higher earners, employees, basically anyone trying to avoid marginal tax traps. This £2,000 cap changes everything completely. So why does this link back to the 2024 budget? Well, in 2024, we were told employers' national insurance rises to 15%. the NI threshold is going to drop to 5,000. These changes pushed everyone towards salary sacrifice. Employers used it to manage their labour costs. Employees used it to protect their take-home pay. Higher earners used it to avoid kind of brutal marginal tax rates. I had a client, he was on a salary of £95,000 a year, and really fortunately, he got a pay increase, and it took him to £106,000 a year. Amazing. An £11,000 pay increase, but he kept none of it. And crossing that £100,000 line removed some of his personal allowance. It was triggering a 60% effective tax rate. It removed tax-free childcare for his 2 children. And actually, all of a sudden, salary sacrifice was the only fix available to him. We pushed part of his pay into pension and brought his income back below £100,000. And this is exactly why the 2029 cap is going to matter. It's removing a planning route that thousands of families have actually been relying on. What actually changes in 2029? Well, first £2,000 of sacrifice avoids NI. Everything above that, it pays on it. So income tax relief is going to stay the same. Annual NI savings of £1,000 to £3,000 a year are going to disappear. For employers with multiple staff using salary sacrifice, this becomes a permanent cost increase. So what are the strategies for small business owners? Well, firstly, use salary sacrifice while it's still there. You've got until April of 2029, so you've got 4 tax years left where salary sacrifice is actually really, really powerful. This is great for the people who work for you because it can keep their income under 100,000. You can stay out 40% tax, protect against child benefit. And what you're really wanting to do is you're wanting to soften the cost exposure on employers' national insurance. And it's a boost to pensions. And it's very, very effective. This is the window to crunch the numbers. Secondly, expect a shift to employer contributions potentially. After 2029, once sacrifice loses its NI advantages, employer pension contributions might become the cleaner, simpler, predictable route. We still need more detail on all of this, especially for directors who have got very low relevant earnings and what's going to happen there. So there is a bit of time before we get the detail. Thirdly, if you've got employees in the £60,000 to £80,000 or 100k zones, then actually salary sacrifice is still going to work really, really well for them for the next 4 years. But I think it's probably a good idea to understand who it's going to affect, because things like child benefit taper, personal allowance taper, 60% effective tax rates, although they seem like, hang on, these are my employees' problems, they're partially your problems as well, because sacrifice is currently protecting them, and in some respects it's protecting you because they're getting a good deal ultimately. And from 2029, that protection is weakening. Yeah, you've got the next 4 years to kind of plan this and map it out on what's going to happen. My fourth point is expect employees to negotiate harder. Salary sacrifice has been one of the kind of the few tools that employees have actually had in order to manage aggressive tax cliffs. Once capped, more pressure is going to land back on the employers during salary discussions. I think you're going to have to model out salaries, understand and talk to employees about pension offerings, and keep an eye on how this legislation is going to develop. So I want to revisit something from the 2024 budget, which people have almost forgotten about. There's been so many tax changes that it's hard to keep up, isn't it? And this one is going to need a video on its own, and I'm already working on that as well. So make sure you've pressed subscribe, because this is a really important point. From the 6th of April 2027, most unused defined contribution pensions will fall into your estate for inheritance tax. Previously, they were usually outside of IHT. So if you died with a large pension and a large estate, your pension could now actually face 40% IHT on death. I know this isn't a terribly cheery subject to think about it, but hang on a minute. There are some edge cases where you can actually end up paying 88% to the government. And that's because your estate's paid 40%, and let's say your children who would draw the pension then have to pay their income tax. Most small business owners won't be affected, but if your estate could exceed £2 million, or you rely on pensions being IHT safe, then this rule is going to matter to you. I want you to go and have a look at your nominations that you've made on your pensions, especially important if you've got divorced. Your will, again, make sure that's up to date and you've got your statement of wishes there as well. Have a look at how your executors are set up. Anyway, there's a full video coming up on IHT and pensions. So make sure you've subscribed. So I think we're at the point where we better talk about dividends, savings, and property. And this is going to be a 3-year tax squeeze. From April of 2026, we've got a dividend tax rise. We're going from 8.75% to 10.75% and 33.75% to 35.75%. Typical director shareholders will pay £800 to £1,200 potentially extra for the same sort of income. And that's why you need to look at your remuneration plans really, really carefully. From April of 2027, we've got changes to savings and rental income. 2 percentage points across every band. 20% goes to 22%. 40% goes to 42%, and 45% goes to 47%. And yes, rental profits move these higher property income bands. There was also a quiet line in the budget that most landlords will miss, as if you incorporate your property business using a partnership, you now need to apply for incorporation relief under Section 162 of the Tax and Capital Gains Act of 1992. So that's a big procedural shift. So should you incorporate your property business? I have a dedicated video on that exact question. It's coming up on screen now. Landlords really need to understand the direction of travel here, because even before this 2% increase, I've seen cases where mortgage interest restrictions meant clients were paying more tax than profit being generated. And add another 2% rise on rental income, you can see why 2027 is a planning year, not a wait and see year. And remember, this follows the 2024 budget change, where the starting rate of SDLT on second homes and buy-to-let purchases jumped from 3% to 5%. So the entry cost is higher, the ongoing tax is higher, and the margin pressure is higher. For landlords, this is the moment to step back, run the numbers properly, and review structure. Look at your gearing and think about your long-term plans. If you are a landlord, then check out my video on making tax digital, as it's possible that you might soon need to start making quarterly returns, and that's coming up on screen as well now. So from April of 2027, cash ISA limits changes are happening. If you're under 65, you can now only put £12,000 of cash into your ISA, and the rest is going to have to go into investments. I think some strategies here is that you probably still want to try and maximize your ISA allowance, and actually putting money into pensions could be a pretty good move. Reworking that director pay plan before April of 2026, I think is going to be a good move. And landlords, I think, stress test those yields and think about what's going to happen with those higher tax rates. I think review company structures and joint ownership as well, things like deeds of trust. And if you don't know what those are as landlords, then go and have a look into them as well. But thin margin properties, I think we've got to consider about exits before April of 2027. Corporation tax rates are going to stay the same, thankfully. We've got that 25% rate, but if you're earning under £250,000 worth of net profits, then we've got this marginal calculation. You may have noticed something else sort of related to corporation tax, and that was that there's a change in January of 2026 to do with capital allowances. And you might have seen that there was a 40% first year allowance applying to some plant and machinery. Most small firms aren't going to be affected by this because they're within the annual investment allowance or full expensing limit, which allows 100% immediate deduction. So the 40% allowance mainly matters if you've exceeded the AIA limit. Think about it if you're buying assets that might not qualify for full expensing, or if you're doing larger capital programs, I might need to think about staging that out across multiple tax years. One particular point of note, though, is from April 2026 that the main pool writing down allowance is going to drop from 18% to 14%. You know, a lot of things will fall into AIA, but if you are buying CO2 emitting cars, for example, then it's likely that those sort of allowances will affect you. The message here is to time capital purchases carefully. Most small firms can still use full expensing or AIA. And I think combine capital planning with pension contributions to keep your profits under that 26.5% marginal tax band. There were a few other things that were sneaked into the budget, so let's have a quick look at those. There were some HMRC payment reforms, some information about making tax digital, and a few other headlines. HMRC are going to overhaul the way their payments work from April of 2029. So if you're in self-assessment and you have PAYE income, you're going to pay more tax through PAYE. And I think the aim is to obviously get more timely payments. In practice, it's going to shorten the tax payment cycle. Those with self-employed income will potentially face more frequent payment points. This is maybe a cash flow planning issue for some small businesses. I'm hoping there's going to be a bit more detail on this because most of my clients seem to hate the payment on account system. So maybe if we've got better real-time reporting, we could actually see away with that and just actually pay the tax that's due when it's due. There was some good news about making tax digital as well. We've got a soft landing for landlords and sole traders earning over £50,000 who are joining Making Tax Digital in April of 2026. There's no penalties or for late quarterly updates until April of 2027. I mentioned my video about MTD for landlords, but I've also got another one for sole traders, and that's coming up on screen. Other quick headlines is there's going to be an EV mileage tax from 2028 at 3p a mile. I still maintain that EVs are one of the most tax advantageous things a company can do. They're great for the directors, and I think even at 3% mileage rate, it is going to replace fuel duty fundamentally for those driving electric cars, but there's still some great tax advantages and benefit in kind rates. We already know about those. They're increasing at 1% a year, but at the moment, 3%, I think it's great value. There's a fuel duty freeze until September of 2026, and there's going to be a new council tax surcharge on people lucky enough to have homes over £2 million from 2028. So I want to give you a 5-point action plan that you can take away today with some dates. Number one, before April of 2026, I want you to rework your salary and dividend mix. Get ready for this rising dividend tax. Secondly, before April of 2026, I want you to map out your capital spend. Ensure that you're still within that AIA allowance, but time asset purchases to save the 26.5% marginal tax rate. Thirdly, before April of 2027, review your savings and rental income. Consider whether restructuring or exits are going to be needed. Fourthly, before April of 2029, audit all salary sacrifice arrangements. Prepare for PAYE-based self-assessment payments or more frequent self-assessment payments. Fifthly, every year until 2031, you need to check your income against the bands because thresholds are frozen. Frozen thresholds are one of the biggest stealth tax rises in this entire budget, and they're not to be underestimated. So am I worried about the 2025 budget as a small business owner? Do you know what? Not really. I made peace paying more tax last year. I stopped trying to force myself under 40% tax band, and I focused more on earning more instead. Yeah, the government still takes more than half of anything extra I earn, but I still end up with more in my pocket. And that's a shift in mindset that sometimes it does help. The real answer here for most small businesses is about growth. Growth in revenue, growth in profit, growth in efficiency. And that's why I've been talking to you more in depth about this budget review. I want you to think about things like your pricing structure. I want you to think about how you're paying yourself because there's efficiency in all of these things that we can find. It's why I've built something called a modernization diagnostic. It's a simple tool that I'm helping to apply to businesses to show where processes are holding them back or where we can put some simple stuff in place to give them some big wins. I suppose if your business feels heavy or it's not growing or it's very admin led, then it could be something that we could really help you with. If you go to my website, which is askjt.co.uk, you can learn more. And if you want to see what modernization actually looks like in practice, then my next video walks you through how I automated 400 tasks a week in my own firm, and that's coming up now. And I'll see you soon. Thanks.